There's about 22.5, nearly $23 trillion sitting in the United States banking system right now, as deposits in cash. Most of it didn't exist a generation ago. Your bank didn't go find that money. It made it. That sounds like an accusation. It isn't. It's just how banks create money out of thin air, and almost nobody is taught the real version. You may have heard the textbook name for it, fractional reserve banking. Hold on to that phrase, because by the end you'll see why it doesn't quite describe what really happens. Here's what you'll understand in the next few minutes: where the money in your account actually comes from, and what quietly holds the whole thing together. So let's start with what most people believe. Picture a bank as a vault. You put your savings in. The bank takes those savings and lends them to someone else. Money moves from a saver to a borrower. Same money, new hands. The bank just sits in the middle and earns the difference. It's a clean story. It's also wrong. The Bank of England, one of the oldest central banks in the world, said so directly, in plain language, back in 2014. Banks, they wrote, do not simply lend out the deposits that savers place with them. That's not the mechanism. So what is? When a bank gives you a loan, it doesn't reach into someone else's account. It opens yours, and it types the number in. That deposit is brand new money. It did not exist a second before you signed. No saver's balance went down to fund it. It creates the money, right there, the moment the loan is made. If that feels like it can't be legal, it is. When the bank makes the loan, it writes down two things at once. It's now owed the loan, that's money coming to it, and it owes you the deposit, that's money it owes out. The two match, the books balance, and the economy has a little more money in it than it did a minute ago. Keep one number in the back of your mind as we go: 0. In a few minutes, it's going to quietly break the textbook story you're about to learn and show you what was really holding banks back all along. Because if you took an economics class, you probably learned a different version of this, the famous one, fractional reserve banking. It's worth walking through because it's half right. A bank keeps a fraction of every deposit in reserve, say 10%, and lends out the rest. So you deposit $100 and the bank lends 90. That 90 gets redeposited and lent again, round and round. Run the full loop, and that original $100 can support up to $1,000 of deposits across the system, 900 of it brand new money. The shortcut is just 100 divided by 10%, 1,000. It's a tidy model, and generations learned it. But the Bank of England's whole point in 2014 was that this isn't how it actually works. Banks don't wait for reserves and multiply them up. They make the loan first, creating the deposit, and arrange the reserves afterward. The famous model has the order backwards, which raises an obvious question. If reserves aren't really the brake, what is? Here's where it gets concrete. In March 2020, the United States Federal Reserve cut the reserve requirement to 0%. Banks are no longer required to hold any fraction of your deposit in reserve at all. And if the textbook story were true, that would mean infinite money, 1 divided by 0. But nothing like that happened, because reserves were never the real limit. What actually limits a bank is whether lending makes a profit, whether anyone wants to borrow, and the safety rules on how much of the bank's own cushion has to stand behind its loans. Take reserves to 0, and those brakes are still firmly on. The central bank still steers the whole thing too, mostly by setting interest rates, the price of borrowing, and sometimes by creating money directly to buy financial assets. So this isn't banks printing freely. It's a system with a hand on the wheel. Now look at what that system has actually done. Back in 1970, the broad United States money supply was about $600 billion. Today, it's about $22.8 trillion, a record high. That's roughly 36 times larger in about half a century, and the recent jump is sharp. Just before COVID, in February 2020, it sat at $15.4 trillion. By its peak in April 2022, about 2 years later, it had climbed to $21.7 trillion. That's a 41% increase in 2 years, the fastest stretch on the modern record. One honest note on those numbers, because it matters. There's a narrower money measure that appears to have exploded overnight in May 2020. Don't be fooled by that one. Most of that jump was just a relabeling. The Fed lifted an old limit on savings accounts, and trillions of dollars got recounted from one column into another. The money didn't appear, the label moved. The real growth story is the broad measure, and it's the one we just walked through. So, did all that new money cause the inflation that followed? Here's the honest answer, said plainly. No one can prove it either way yet. One camp lines up the money surge against the prices that came right after, and sees cause and effect. Another points to supply chains, energy, and a reopening economy. Both are serious cases. What doesn't hold up is anyone who tells you it's settled, because the people who actually study this still genuinely disagree. But step back from that debate, and the deeper point holds either way. Money isn't a fixed pile that banks pass from hand to hand. Most of the money in the economy is created by ordinary banks the moment they make a loan, typed into existence as a new deposit. The money supply isn't a thing the system holds. It's a thing the system grows. And once you can see that, the obvious next question is the one that actually keeps the whole thing in check. If a bank can type money into being, what stops it from doing that forever? There are real limits: the bank's own cushion, who's willing to borrow, and the central bank with its hand on the wheel. And those limits are what hold the entire banking system together. That's the next one, if you want to follow along.